Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kirk Kreckmeyer, the Principal Advisor at Pebble Valley Wealth Management. We are a fee-only financial advisory firm helping our clients make informed decisions on their road toward financial security. You can find more information at pvwealthmgt.com. On today's show, I'm going to provide a market update with returns to the end of June. I'm recording this podcast on July the 2nd. Happy 4th. Early, by the way. As a brief legal disclaimer, my discussions here should not be construed as financial or investment advice, and each person's situation is unique. All right, let's go. So we're going to follow the usual format. So on the screen now, you're going to see our usual graph is showing the returns of the major asset classes. Nothing really jumped out as a clean pattern. It was a bit varied throughout, but there's a lot of action going on underneath as it usually does. And so you can see starting at the top, the U.S. large caps were actually down about 1%, but yet right below that, the small caps were up 3.75. So quite a variation in the large and small. The theme from the past, U.S. large cap index was heavily dominated by tech stocks, and those stocks have been lagging, underperforming so far year to date. So I have a graph later on I'm going to show you highlighting that. On the international side, there again, call it kind of flat, but the emerging market was actually down 1.4. So their main difference or main drivers on the international side was a stronger U.S. dollar, always makes returns in the U.S. market lower, and the driver of that is the Federal Reserve, which we'll talk about later as well. Looking at the bonds, bonds are always exciting. Interest rates were up actually, but only on the short end. So the longer end of the curve, things were down. So I was kind of surprised that the short dated treasuries were actually positive, but they are. So that's good. The one negative that you see in the bond land is going to be in the tips. Inflation, we'll talk about inflation and the commodities in a second, but the real yields were going up, as concerns about inflation. And so rates go up, bond prices go down. So that's why the tips were showing a negative there. And then corporate, nothing really jumps out. Credit was relatively stable. So, and then the really ugly stuff is at the very bottom. So commodities, I mentioned that. So one, the good news is there's actually starting to have some ships flowing through. It's definitely not back to normal by any stretch, but some ships moving through the Strait of Hormuz. And so you've got oil prices. They were falling last month and again here in the month of June. So on the screen there, you see the commodities being down 8.5%. Most of that are the big drivers. One, energy, and then two, precious metals. They were down about, 12 or 13% for the month. If you look over a year-to-date column, they are still up 14%. So it just shows you how strong they were. And you'll see a graph pretty soon that shows that graphically. And then, of course, Bitcoin. So minus 20%. That is correct for the month alone. I got clocked pretty hard. Drivers there, again, fundamentals remain strong. So I am an investor in Bitcoin. I remain bullish. Fundamentals still remain very solid and feel very good. But it's just right now, the crypto winter, they call it. A company that's been issuing some products that is getting some pushback, some of the leverage unwinding. So recently, again, I'm recording this on July 2nd, things have been rebounding nicely in crypto land. But again, without a doubt, down 20% is a pretty ugly showing. So that's it for that graph showing you the ETF tables. Then the next thing that we move to, and it's going to highlight, I was commenting about the commodities. So on the screen now, you're going to see our year-to-date returns for the major ETFs. And so this is similar information as what I just showed you on that table, but one, I use ETFs, not the actual index, and two, it shows you the path that got there. And so the bubbles on the far right there shows you the ending year-to-date returns. It's going to be very close to the table up above. But what I like about this is you can see the movement going there. So earlier I was mentioning commodities had fallen quite a bit in May and again in June. So you can see that green line there, got as high as, let's call it, 35%-ish. I don't even know exactly, but all the way back down to 16. So you can visually kind of see the run it had and then the pullback. Emerging markets, they've been running in second place year to date, the magenta line there, but that's the highest returning year to date right now, but it's got its share of volatility, as you can see. And then the orange line right below that's the small caps. And so, small caps are, they've been lagging for a while. And so part of it is just valuation. They're finally having their time in the sun, if you will. Because they're going to have, if rates stay higher for longer, which I'll talk about next, that's going to hit smaller companies harder, but they seem to be plowing through that and doing quite well. And then in the middle there, again, the overall U.S. large cap and international developed markets. And what's the other one there? 975, 988. REITs. Those are the clumped, the three in the middle there. So nothing really going on at the index level. Again, plenty going on underneath. And then, of course, that nice, steady, not going anywhere line, that's the good old bonds. These are total returns. And so that does include the income you received for 6 months worth, which would have been, let's call it 2.5% maybe. But rates have gone up for the year. And so the slight price drop. And so net total return, you're positive about 0.75. So that's the end of that graph. And before I jump to the interest rates, I guess, I thought I'd show you, looking at, what interesting drivers, are going on. And so I thought I would talk about, and if you read my blog post at the very top, I have my lead in is a quote, Jesse talking to Woody, taking a little Toy Story 5 theme, but, tech is everything. So I thought I'd play on that theme. So on the screen now, I'm showing a graph of the Magnificent Seven relative to the X Magnificent Seven. So the Magnificent 493, if you will, relative to the overall S&P 500. So you'll see the orange line. So, and there are a couple of ETFs. There's an ETF for everything these days. And so the orange line is that Magnificent Seven. So the 7 stocks, sorry, I didn't get the names down before I started here. So I'll look it up. But, the Amazon, the Apple, Tesla, Google, and a few others. I can't think of them right now. But anyway, the Magnificent Seven has been trailing. You can see, this is a year-to-date number, throughout the year. And so the other 493, the X Mag 7, that's that blue line, that's on a year-to-date basis, positive 15.5. So that's quite a swing. That's about 17, 18% swing on a year-to-date basis between what used to be the hot Mag 7 names versus the other 493. And so just be aware of the concentration in the market, and when things can change, it can really drive the overall market impact depending upon its weighting. The other thing, and now I'm going to show you a new graph on the screen. I wanted to include them both, but it was such a large move, it got lost in the noise. And so it's like, well, if the Mag 7 is lagging here, underperforming, and Woody was saying that tech is everything, and I agree. It's like, well, where's the money going? And so the next graph that you see there, that green line, are the chips, the semiconductors. And so starting in April, those things just exploded. And so again, the AI story is still out there. It's still great technology. We're using it. A lot of people are using it. But what used to be the large hyperscalers, if you will, building the data warehouses, cranking out the computing power, still very important. But now a big shift is going into having enough chips to keep cranking away. And so there's a huge explosive run there. And so, again, recall, started this blog post, U.S. large caps were down 1%. Nothing's going on. Let's move on. There's a lot going on. So it's important to look underneath the hood. And if you have a view and want to express it, just make sure you're aware of what you got and how you want to express it. So that's the end of that graph. And now I typically turn to, I typically turn to interest rates here. So interest rates, we'll talk about the Federal Reserve after this, but up on the screen now, I'm going to show my usual 1-year graph. I also have a 30-year graph on my blog post, which I won't show here, but I started doing the 1-year, just a bit more granularity, so you can see the movements that are going on more recently. And normally, I don't talk too much about the 2s, 10s curve, let's call it, but this time I want you to focus your attention down below. So look at the 10-year minus the 2-year rate. I call it the 2s, 10s curve. Pretty big move again in bond land anyway. So, it was as high as, call it I guess for the year, it was even close to in the 7.75, even higher than that. We're now all the way down to 0.3%. And so it's like, well, Kirk, I don't care. What does that mean? 2s, 10s curve. I don't trade on that. So I just want to point that out, pretty big move. Now, if you look up, go back up to the graph and take a look at that orange line, which is a 2-year rate, definitely a steady climb throughout, call it since March, steady climb up, and it's now at 4.14 on the screen there. It was as high as, I want to say, close to 4.25. But then if you look up at the green line, that's at 4.91. That, has been climbing up and coming back down, but relatively flat versus that 2-year. And so the short end of the curve, the 2-year rate, is going to capture what the market thinks the Fed is going to do, whereas a 10-year captures more of potential inflation expectations and other things, technicals, supply, demand, but more of the inflation expectations longer term. So what the chart is saying is the Federal Reserve may be starting to raise rates. If they succeed at fighting inflation, maybe the long end stays down. But it was an interesting move that caught my attention this time. And then anything else here? Let me just take a quick look at my notes. Yeah, I guess again, the headline numbers, again, the The 10 years holding on to that 4.5%. I'm sorry. Yeah, 4.5% rate. Shows 4.44 here on the screen. But again, recording this on July 2nd, it's tickling 4.5 again right now. And then the 30-year, the green line at close to 5%. Again, current rates right now just under that 5% level. So that's a quick summary of the bond graph. So now I normally talk about the exciting world of the Federal Reserve. And so let me just provide a few words, and I'll show you a picture in a second. But for now, the big news was June 17th. Yeah, June 17th was the last FOMC meeting we had, but it was the first meeting that the new chair, Kevin Warsh, chaired. So the question was, okay, he was brought in. He's going to favor cutting rates. What's he going to do with this higher inflation? So a few things happened. One, definitely the tone was much more hawkish than the market was expecting. Hawkish meaning the market was expecting, if they use the term hawkish, that means they're likely to raise rates. And if they use the term dovish, they may be cutting rates. And so the market was expecting maybe a neutral. They weren't quite sure, but it was much more hawkish than the market was expecting, i.e., leaning toward potentially higher rates. The second thing, the Fed statement. So they put out their statement. It's typically, I think it's 5 paragraphs. Certain things are stated, forward guidance. This one was very, very short. So they put it out, but they explicitly, the Chair Warsh said, we are not going to provide forward guidance. So that was a big change, lot smaller statement. What else did they do? They announced these 5 areas that the Federal Reserve works on or uses in their communication and their work, and they want to Chair Warsh wants to review those, put a task force together for each one, review them, and make recommendations of changes that maybe the Fed should consider. And so those 5 areas are communications, or the balance sheet policy, which I'm going to get in a second, the data sources they use. Trying to use technology to get more real-time data, the productivity impact on jobs, read this as AI and what it's going to do to the jobs market, and then the inflation framework, should they have this forward guidance, is 2% the right number, et cetera, et cetera. So those are the 5 things they're going to focus on. They're not jumping out to conclusions right now, but they're going to pull together experts, study it. But he did say, and I'm a man of action myself, and so it's not going to be like a study that goes on forever. He was asked the question in the press conference, and he expects their answers and implementation before the end of the year. So, which is pretty fast for a framework and policy group like that. And then they also put out, so every 4 times a year, they put out the summary of economic projections, and they did that. People expected them to, but they weren't quite sure. And one of the things that are included in the summary of economic projections are something they call the dot plots. And so they had it, they released it, and people were like, well, that's forward guidance. I thought they said they weren't going to do that. The dot plots indicated that there's not going to be as many cuts and even maybe a few raises. And so that caught the market, again, kind of that hawkish stance. But 2 important things. One, Chair Warsh did not provide a dot on the dot plot, and 2, so he didn't provide a dot plot, and 2, he played it down on people put in their projections, but they use a pencil, not an ink pen. So I fully expect that dot plot will be going away. They probably still will providing economic projections, but less emphasis on the dot plot, because that implies that forward guidance that they're trying to minimize. And then the other thing too, now I'm going to show a graph on the screen here. So as this changes, what is the market expecting? So this is not precise expectations, but one of the things that Chair Warsh said in his comment about I'm not going to provide, or the Fed will not be providing as much forward guidance, very little if any, is he would like to have the market kind of do their thing, not worry about what the Fed's going to do, but what does the market think of all this data? And then the Fed can use that input as they create their policy. So on the screen you're seeing is the market. So this is the Fed Fund Futures. This is a graph from the CME FedWatch tool, which I've referenced many, many times. And it just shows the change in tone or change in expectations. And so if you let's first focus on the blue. And if you look at the bottom of the graph, this thing started back in November of 2025. And at the top of the graph, you'll see this is what the market expects the Fed funds rate to be at the end of 2026. I guess December 9th to be exact, because that's the last FOMC meeting for the year. Early in the year, before the Iran war started, market was not fully pricing in, but definitely expecting the highest probability there, the widest band. This is a stack chart of 2 cuts. And so again, current Fed funds rate is 3.5 to 3.75. That's that highlighted level at the top of the graph. The blue line is the 3 to 3.25. So 2 cuts. So pretty much before late February, early March, when the Iran war started, probably going to get a couple of cuts. When the Iran war started, if you look at the graph going out from, say, early March until the end of May, the war started, inflation kicked up. Maybe we can't cut rates into this high inflation. And so the market priced that out. And now the green bar, the green graph, if you will, the majority likely result by the end of the year was going to be no cuts. So no cuts, but also no hikes, just staying where we're at. And then starting in May, early May there, you start to see this purple line and then the red, I'm sorry, not line, graphs, or the soil chart, they call it, building up. So that was where we started getting hotter inflation readings. So it's like, well, boy, not only is the Fed going to sit tight, but if they're going to be fighting inflation, maybe they have to start raising rates. And so started to come about. The purple is one hike. And then the red, it's like, wow, maybe they're even going to go 2 hikes. And so you can see, finally, I'll stop here, but this little blip, the red soil chart in the far right on June 17th there is that big blip. So it got up to, let's call it 35 to 40%. So it lets you capture, what is the market thinking that the Fed might do, not necessarily the other way around. So anyway, something to look at, and we'll take that off. And that was the quick summary of the Federal Reserve. So, and then finally, my special topic. I was going to say enjoy the summer, right? But I can't help myself. And so the special topic this month, I mentioned it probably at the April market update, and that is the private credit. And so one thing to be aware of with private credit is you cannot just get your money out of private equity, private credit, private real estate deals. So private credit funds typically have a quarterly withdrawal cycle. So you can request how much money you want each quarter. So it was quiet for a while. The market can only concentrate on one thing at a time. So it was in the news, but the second quarter withdrawals were coming about. And same story as the first quarter. People want their money out. There's rules in the documents, if people ever read them, saying, you know what, if you request a lot, the private credit funds have the right to limit your withdrawals to 5% of the fund. People are like, oh yeah, it's never going to happen, but let's just go. So large amounts come in, and the reason they do that is because it's private credit. It's not very liquid. They can't just easily sell it. And so the waves came in, and so I'm going to on the screen now. You're going to see a summary. This is using Perplexity Pro, which is for research anyway, my preferred AI tool. And it shows I just asked for the major private credit funds. And so it shows 3 of the major funds and the amount that was requested. In general, it was anywhere from, call it 12 to 17% of the fund requests coming in saying, hey, I want, total request. I'd like to withdraw, say 15% of the overall fund. And they said, sorry, we're gonna cap you at 5 because we have some issues. We can't sell it, and the value is not quite there. So the one fund that was different, the very top fund on that table that you see there, this BCRED, so the Blackstone Private Credit Fund. Last quarter, they got a big request as well, but they actually honored it. So they made an exception, and they did meet the full, I think it was 8%. Yeah, 7.9% it is. They met it. This time around, they decided not to do that. So it kind of gives you an indication of what's still going on. Again, you haven't heard about it for a while, but those issues still remain. So that's the quick summary of the private credit market. So anyway, that's a quick summary of the market here at the end of June. Again, end of each month, the overall indices may seem somewhat tame. There's always something kind of moving a little different than you'd expect, but there's quite a bit going on underneath. And so just be aware of what you have, both equity, large and small, international, U.S. bonds, you got tips, you got credit, you got private credit, just be aware of what you got and what it's going to do for you. So again, recording this July the 2nd. So happy 4th of July in advance. Big celebration. The year's half over, but our country is celebrating a quarter of the millennium. So that's a big event. So here's to another 250 years, and have a happy, safe 4th of July. All right. That's a wrap on today's topic. Thanks a lot. Thank you for listening to this episode of The Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.